Just to root that on the other side, right, there is still some caution that is warranted. You have return on investment and depreciation risk. So hardware cycles are fast. Asset lives and resale values may be overassumed right now. So what do I mean by that? So AI is moving crazy fast, right? Those fancy H100 NVIDIA chips powering AI right now cost tens of thousands of dollars each. But the next generation, called the Blackwell, that's already coming out, and it's way faster and more efficient, like ridiculously faster and more efficient than those original H100 chips. So if you just built, if you're a company or an investor and you just built a massive data center full of the old chips, you might have originally expected to make your money back over, let's say, 5 years. But now everyone wants the new chips, and you're only 2 years into the investment. So, the old stuff that you have implemented still works. It just isn't worth as much anymore. So that's the risk here. Technology is improving so fast that some of these expensive projects could lose earnings potential before they've even paid for themselves. There's also power and permitting difficulties or risks. So power is a challenge. These data centers use a ton of electricity, and the grid in a lot of places just isn't ready for it yet. So even if companies have the land and the chips, they might have to wait for power hookups or pay more to get them to where they need them to be, which can hurt profitability by either adding to cost and or delaying profits. There's also the valuation problem, right? Valuations in a lot of the areas within AI are at edge. Valuations have surged. Just because an investment might be productive for an economy doesn't mean the price you pay won't be too high to ever get a meaningful return out of it, right? That's not to say, though, that these assets won't get you return, but valuation risk needs to be considered.
Yeah, and I'd also say that we hear a lot about the Mag 7 and the hyperscalers, and I'm sure we'll talk more about that in a bit. But there are many companies trading publicly in the United States that are trading at attractive valuations and are terrific long-term investments, even in the bubble. So again, it's part of diversification and keeping perspective. Some good might come out of this too. I mean, that's ultimately what we hope for, that with the need for power generation and the like, we could build out the energy infrastructure in this country. There's a tremendous amount of spending going on now. There was an article in somewhere today about like the shortage in gas turbines for power, that the order book is, they just can't keep up with the orders. The demand is incredible. And 2 years ago, there are three major players in that, Siemens, GE, and Mitsubishi in Japan. Well, they can't keep up with it. 3 years ago, I think 2 years ago, Siemens only had one order. They sold one gas turbine in the United States. So you've got this potential boom in rebuilding our infrastructure, and there'll be revolutionary things going on in healthcare and medical research and stuff like that. The one thing I would plan for is plan that you'll be living longer, that with the medical breakthroughs coming through, that will be a key part of the asset allocation process, that you're going to need your money to compound longer. And to do that, you certainly don't want to get overly cautious with the equity market.